If you're UK based and earning a high income, this could be one of the most important videos you watch this year. Thousands of Brits legally reduce and in some cases eliminate UK tax on their overseas income by becoming non-UK tax residents. And Dubai is one of the most popular destinations to do it, not just because of the financial benefits, but also because of the lifestyle and the overall quality of life they gain. In this video, I'm going to explain how exactly the UK tax residency works, who this applies to, the legal process involved, and the most common mistakes people make that cause HMRC to continue taxing them. Before we start, just a quick note, this video is for educational purposes only and not personal tax advice. If you're considering relocating to the UAE or exploring your options, you can use the link in the description to speak with one of our certified professionals for personalized guidance based on your specific requirements. We support clients with visas, business setup, and relocation planning. We also offer expert property consultants to help you invest in the UAE real estate market. So let's get into the video. Now, if you're classed as a UK tax resident, the UK will tax you on your worldwide income, regardless of where that income is earned. The top income tax rate in the UK is currently at 45% plus your national insurance tax, whereas Dubai has no personal income tax, no capital gains tax on individuals, and only a low corporate tax that applies in specific situations, which we can cover in another video. So the real question isn't why Dubai, it's how do you legally stop being taxed by the UK. So your tax residency status is determined using something called the Statutory Residence Test, often referred to as the SRT. This is the framework the HMRC uses to decide whether you are a UK tax resident in the given tax year. The test is broken down into three parts: the automatic UK residence test, the automatic overseas test, and the sufficient ties test. This assessment varies case to case, so I won't go into it in too much detail on this video. However, understanding that this test is what determines your tax position is critical. You can speak with a member of our team and they will go over this in detail with you to get a better understanding of your current tax position. So once you understand how your residency is assessed, the general process typically looks like this. Step 1, reduce time spent in the UK. Now you need to significantly reduce your physical presence in the UK. In many cases, this means spending under 90 days per tax year and often much less depending on your previous ties to the UK. Next, you need to establish your life outside the UK. This involves genuinely relocating your life overseas. For many people, this means moving to the UAE, renting or purchasing a property here, obtaining a residency visa, opening bank accounts, arranging health insurance, and spending the majority of your year outside of the UK. Next, you need to reduce UK ties. This can include no longer having a main home in the UK, reducing or eliminating UK-based work duties, and in some cases, even relocating your family over to where you've relocated. The fewer ties you have in the UK, the stronger your non-residence position becomes. Then you need to earn an income outside of the UK. Once you're a non-UK tax resident, foreign income is generally outside the scope of UK tax, provided it is structured correctly and is not a UK-sourced income. So we recently worked with a client who was working remotely for an international business whilst living in the UK and paying a substantial amount in tax each year. They decided they'd make the move to Dubai, became a UAE resident, restructured their finances correctly, and established non-UK tax residency. Now they continue working in the same role, but they earn their income overseas while enjoying a much better lifestyle. This case works because their residency status, work location, and income source were aligned, and this is exactly why professional guidance matters. There are, however, some common mistakes people make when they don't seek guidance from professionals that result in them remaining a UK tax resident and leaves them without the benefits that we highlighted. Some of the main common mistakes that people make include spending too many days inside of the UK, retaining their main home in the UK, still performing work duties in the UK, being paid through a UK payroll structure, or failing to understand how their UK ties affect their residency. So it's important to be clear, UAE residency alone does not make you a UK non-tax resident. So the key takeaway of this video is, if you remain UK tax resident, the UK will tax you regardless of where you live or earn your income. Now, Dubai offers a tax-efficient environment and a high quality of life, but the benefits only apply when the relocation and tax residency process is done correctly. When structured properly, many people are able to legally reduce and in some cases eliminate UK tax on their overseas income. When done incorrectly, HMRC will still treat you as a UK tax resident. If you'd like to understand how this applies to your personal situation, you can use the link below to book a free consultation with our team. And if you're considering moving to Dubai and want clear, honest guidance on residency, visas, lifestyle, and property investments, make sure you subscribe to this channel.